Good morning, everybody, and welcome to Series 2, Episode 4 of Crystal Clear Complex Cases. I'm obviously joined by two special guests. They don't need any introduction, but we have in the Manchester corner, the man, the myth, the wizard. We've got the tax legend, which is John McCaffery. Good morning, John.
Good morning, Dan.
And then the next guy doesn't need any introduction. He's been around since before base rate began. He's like a father figure to me. We've got Roger Morris from One Savings Bank. Morning, Rog. How are you doing?
Morning, Dan, and good morning, everybody else. That was a brilliant, warm and positive introduction, Dan, and you were looking really good at the moment as well.
What are you after? But no, do you know what? You've got to be positive at the moment. Obviously, this industry getting a lot thrown at us. We've seen a lot change again since the last episode of this, which we held in June, and I imagine when we hold the next one in October, we'll be having the same sort of conversations, but it's where the market's going. But as always, we've got a really good session planned today. We're going to freestyle as we normally do and take what questions we get coming into us. So please, anybody with any questions, mostly for the show pony himself, John, please do ask away around tax, pick his brains, challenge him, because those of you that do come on for all of these sessions, first and foremost, thank you. But you'll know that they are always very, very informative, and we speak around what you guys want to speak around and learn about. So I think over the past couple of months, as I mentioned, it's been challenging. Base rate obviously only keeps going up, the cost of living crisis and everything else that's going on in the world. But just for the past, since June, how have you guys found it from a business perspective? And I suppose more importantly, Roger, for you in terms of SLAs and any news you guys have?
Yeah, one thing I would say is I've literally spent the last few weeks moving from the offices to offices, whether it be Interbase offices, Kent Reliance offices, or Precise offices, trying to get those very important cases through. What I do see, Dan, is the first thing I need to do is to check with the broker that we've been given 100% of everything we need. We understand the panic's the wrong word, but the need for a broker to secure a rate. And sometimes they have to send a case in without all the information. But because they're dealing with a lot of other lenders and so much business, they are sending in, and I fully understand it, not 100% package case. So what I'm trying to then do, Dan, is by sending out, our list of requirements and saying to the broker, stop, think, have we got 100% what we need? Not 95%, and certainly not 110%. What I mean is, if we ask for 1 month's bank statement, just send us 1 month, because it'd stop us tripping up. Make sure, I had 3 cases yesterday where they hadn't put the middle name on, and we have to rescore. And the reason we have to put their full name, which the application says, is it pulls through the correct data feed when it comes to adverse and financial problems. Because let's face it, the customer is squeaky clean, Dan. It won't come to our 3 brands. It'll go to one of the high street lenders on the cheaper rate. And you know that as a specialist lender. And then you'll get people saying, well, what does the full name really matter? What does the middle name matter? But it was able to, in the 3 examples, is find linked addresses, CCJs and defaults. So getting the name correct, getting the date of birth correct, and getting us 100% of the information. And then when I have actually been able to get intervened on cases of specific urgency, we've been able to get the outcome they want. But if you take Precise at the moment, Dan, if you get us 100% of what we need, it might be, say, 8 days to underwrite, but it's underwrite and issuing of the offer at the same time. And we've had a lot of success on that. So it's a working partnership. Lenders have to work, if they can at the moment, 7 days a week. This market won't last forever. Eventually it will slow down as people start to really understand about the interest rate rises. So it's a matter of teamwork and partnership with the intermediaries, who ultimately, Dan, are my boss.
Yeah, no, absolutely. I couldn't agree more. And I think looking at specialist lenders and the lending market as a whole, people still want to lend. The money's still there and it's still available. Yes. I think a lot of people that'll be on this, myself included, obviously you have, but most people haven't. We've not been through a rate rise before. So a lot of people don't know what to expect with rates being pulled, given kind of 5 hours notice and such. But I think the great thing about the current market that we're in is it's an easy sell, because there's only one way the rates are going to go, and it's north, isn't it? So ultimately, if clients are waiting for better rates, sitting around, it's not going to happen, is it? So I think
Dan, can I pick up? You've made a really valid point there. Sorry to interrupt you, but it's such a good point. Is why do lenders pull rates quickly? Why can't they give time? So we get lots of brokers who are saying, Rog, why can't you give us 3 days, a week, a month? And the reason being is when rates are rising so fast, the rate itself that was issued is calculated against a certain return. So the longer you leave it out there, the more that massively impacts the profitability of that rate. And that's important primarily, that if a lender's not making money, it will go bust, which is why a lot of the smaller lenders are having to react very quickly. We within the OSB group, wherever possible, like to give 24 hours. We would love to give longer, but if we give longer, you would be top of the league table, you'd be swamped with business. And where brokers are saying, give us longer, so let's say we give them 3 days and we got swamped with business, the problem is then, Dan, is your service would be absolutely battered and you could move out to 3, 4, 5 weeks. And then the brokers are going, well, you shouldn't have took too much business because that you should have pulled the rates easier. But then from a broker point of view, brokers are dealing with clients where they've got to get the quote, they've got to take it out the client, they've got to get hold of the client, they don't want to stress the client out and they want to get the rate in, and they want to be able to say to the client they've secured the rates. And the brokers have got a real challenging job when dealing with the customers, and it's not easy. So massive sympathy for brokers and massive sympathy for lenders and the staff within this situation. I remember, Dan, when you were born, interest rates were about 15% and it took 80% of our household income. And we've seen interest rates move up and down, and we're going to move into a recession next year, but it'll be the first recession, as John will speak in a second, where we can't get enough staff. We all want to expand what we're doing, so it'll be a weird recession. But what you will see is interest rates, in my personal opinion, by 2025, and this isn't an OSB group's opinion, will actually settle and will actually come down and inflation will drop. But that's subject to be no more escalation in world wars or pandemics or problems. But I just think there'll be a bit of a curve, hopefully a curve and a bit of normality to go over. So sorry for interrupting him, but that's what lenders have to put rates up.
No, I get it, and it's a great overview for a lot of people, because people just assume that you're pulling products for, I suppose, greed and stuff like that. But ultimately, I mean, look at Nationwide a few weeks ago. They changed their rates and put their rates up because the SLAs were horrendous. You were looking at 21 days. So to counter that and to get the service back, then they put the rates up. Unfortunately, after that, everyone else did, so they were back in the same boat, which is quite funny. Obviously, we don't deal with the high street and that sort of stuff, but sometimes it's not just down to the fact that base rate's gone up, it's to manage service levels, isn't it? So if you don't want the business, unfortunately, you're going to do it. So there's ways and means, but again, I think it's the easiest sell that people are going to have. Certainly for ourselves from a sales point of view, because again, rates are only going to go up, and if clients are sat waiting around, then unfortunately, if the rates are pulling, it's no fault of their own. It's kind of like the petrol station. We've all done it. We've all looked at petrol. We've all whinged about petrol, and we've all, even the petrol prices, you look at where the cheapest petrol is, you go there, you sit in a queue for 10 minutes and you save £3 off your tank.
Yeah.
But with portfolio landlords, if they're not looking at getting the best deal and not looking at securing it now, then that £3 actually could turn into thousands of pounds a year or even thousands of pounds a month in terms of payments. So if they're not looking to review it now and they're coming to the end of the fix, or they're on a tracker hoping that it's going to flatten, then unfortunately the rates again, they're going to keep going up, and they will for some time, unfortunately. So I suppose watch this space. And John, how have you found the past couple of months? I know there's a fair bit going on in your world at the moment.
There is. I have to say, there's a massive, as Roger alluded to, there's a massive shortage of staff in my world at the moment. And being able to get out and deliver on work is proving a real issue. The volume of work coming through at the moment is enormous, and it's the same across the profession. So it's a very strange circumstance, because you're hearing lots about recession and downturns, but the work coming through to me at the moment isn't indicating that at all. People are still active, people are still doing stuff. We'll see as it's possibly a consumer-led recession. So industries like leisure, may be impacted, but you don't know, because I think after a pandemic, people are kind of very much wanting to get out and see things. So yeah, it's going to be, to quote the ancient Chinese curse, interesting.
No, absolutely. No, thank you for that oversight. It's been useful, but as always, we'll jump into the questions. So again, anyone who's got any questions for myself, for Rog, for John, we've got obviously an introducer, a lender, and a tax advisor on here. So we're suited for all questions. Just a bit of a compliance comment, as Rog alluded to. So me and Rog, we're not qualified to give tax advice, so there may be our opinions as such on certain topics, but John is the fully qualified, all singing, all dancing tax wizard. So any tax questions, then he can give advice, but ultimately we can't. Morning, Rory. Thank you for joining again. Rory comes on every single session. He's a great advocate of these webinars, so thank you very much. But let's go into the first question. So we've got Kieran. Thank you very much for this. So on taxation, this is for John, obviously. What is the cost of uplifting a portfolio of 40 properties to an LLP with an attaching service limited company and preparing accounts on an ongoing basis?
Small question, lots of problems. Right. Taking the first bit, moving from personal ownership to an LLP, actually of itself, and there is a tweak to this, but of itself doesn't create a tax cost. For tax purposes, LLP partnerships, limited liability partnerships, are transparent. So you're still deemed to own the asset directly. The tax admin changes, you need a partnership return and you put partnership income on your tax return, which is really important to do actually in terms of maybe incorporation relief. Unless your partner, an LLP, and an LLP requires two owners of some description, is a spouse, civil partner. If you transfer assets to a partnership, you are making a disposal of the portion of the partnership that belongs to the other party. So in those circumstances, there is potentially a capital gain on that portion, and it's a capital gain across your entire portfolio, because partnerships assets are deemed to be owned joint and severally, which means if you've got 5% of 40 properties, you've got 5% of 40 properties, not specific properties in the portfolio. Same issue on stamp duty. So again, you're transferring 40 properties, whatever portion you dispose of potentially gives rise to a stamp duty land tax charge. Okay, so that's the first thing to be wary of. Right, companies and partnerships are by and large, not in all circumstances, by and large, a disaster. Okay, so you've got the situation, let's say you've got a service company that is owned separately from the partnership. Yes, it can provide services, but the disasters I've seen are, one, if it's providing services, it needs to charge for services. If it's charging for services and they're over 85 grand, you've got to VAT register them. If you VAT register them, your partnership can't recover the VAT because it's providing an exempt service. Rental of properties is exempt. Okay. The worst scenario I've seen is whereby you have properties in personal ownership and the service company collects the rent, right? And then you're trying to get the rent taxed at corporate tax rates and the partnership's just having the capital growth. In that scenario, you've got all your rental profits being taxed in one place. And then you can't get any interest relief because the company doesn't have the debt. So you've got a load of tax at a 19% rate, great, but no offset for any interest. Yeah. And if you try and arrange it so that you've actually sublet the properties to the company, then you're paying corporation tax and a margin in the company, right? But you've still not got the debt in the company. And then you're just moving all the rest of the profit back into your partnership, and it makes not a blind bit of difference. The third scenario is whereby the company is a partner or member of the LLP, right? Can be done, but you've got to be really, really careful the revenue don't view it as a form of profit shifting. So basically what you're trying to do is get the profits of the partnership taxed at the corporate tax rates through that member, because as I said, it's transparent, so it goes up to the corporate member as well, the company member. There is specific law that prevents you from doing that if you're trying to, and it will tax it right back on the other members, the income tax members. So it doesn't do any good at all. The other kicker on that is if you later try to incorporate the partnership into the company, you can't claim incorporation relief because there's a specific case law that said that if the company already owns part of the business, you're not transferring the whole of the business into the company. It's a really techie point. And one of the requirements of incorporation relief is that you transfer the whole of the business. So, as I say, little question with loads of permutations. Unless it's a very, very specific set of circumstances, I generally wouldn't involve a company in a partnership.
Perfect. No, thank you for that. And I wanted to start with a complex question just to show kind of what you, well, I know it was very heavy, but just to show the level of.
I'm surprised we've still got the same level of participants after that.
Yeah, no, and that was a very heavy question, but just to show your level of knowledge and your wealth of knowledge when it comes into it. Now, let's flip that on its head. So let's say that was all fine and one of the scenarios was fine. Rog, from a lender's point of view, what would your view be on it, whether you want to do it from OSB's view or your personal stance in terms of?
No, we would just laugh at that, because you've got to think from an advisor point of view, where's the affordability coming from? So what is the affordability on a buy-to-let? Buy-to-let's a non-status, Dan. We're not interested in your income as a person. We're interested for the income from the property. Well, you've given that away. You've put it into a limited company. Or are we going to are you putting the loan through in a limited company, which is the one that's got the income, but it doesn't want the liability? Yeah. And if we did allow such a mechanism of an LLP in a limited company where we've knowingly, our applicants are, say, Dan and John, we've knowingly taken your application and we've knowingly accepted that you are not going to receive any income from the property from affordability that's good in a limited company, and you went to court because you weren't paying your mortgage and said, Your Honour, the lender knew we weren't receiving any money from this property and they accepted that it was going into the limited company, and now they're wanting to foreclose on the loan, but we haven't got any money to make the mortgage payment. Do you see what I mean? It just cannot work from an underwriting point of view, Dan. It just hasn't got legs. If you've got to underwrite the application on the security, the equity and the income, and if you start moving the income, and the only reason you're doing it is for in my opinion, as a landlord, is because you want to claim the interest back and you want to be able to maximise George Osborne rules. And I don't think that, in my personal opinion, you're being fair, open and honest and transparent with the revenue. So as a landlord, you either keep it in personal names or you keep in a limited company and you just accept the rules and you stick by them. But from a lender point of view, it's a no.
Yeah, no, absolutely. Absolutely, I agree. And even there's a lot of creative ways out there at the moment where accountants have been on a little bit of a course and they're trying to be clever, or they fully don't understand the situation and scenarios. But even moving it from individual to LLP and then limited company, following the Ramsey ruling from the old years ago, which we originally started the journey of the taxation on when the new changes got announced. But unless they're a commercial lender, which again, there's not many of those in the marketplace and rates are higher, then your mainstream lenders aren't going to look at that structure because they know exactly what you're doing. And it is going to be deemed ultimately a tax avoidance because it's not a true structure and it's not a genuine enough reason as to be able to transition the properties from individual to limited company, is it? So there lies your biggest problem. And again, the bigger the lender, the higher the risk and the worse reputation could be damaged should anything like this be in the papers. I mean, we've all seen bloody HSBC in the papers over the years for a number of things.
Yeah.
See, me when I worked there, we used to always get hammered, but you just don't want the reputational risk. And there's enough business out there to shy away from these sorts of deals. So again, I think if anyone's being clever in terms of the structure, they just need a second opinion from the likes of someone like John, who actually knows what they're talking about. You can do it the most cost-effective way, but ultimately it's a legitimate way which lenders will actually support moving forward. Well,
and Dan, if you get it wrong, HMRC can come back to you and take the capital gains and take the stamp duty. And that's why you're better off doing, Rory O'Mara's listening, he was a very good close friend of mine, and Rory will tell you, do your due diligence, do your facts. And if your gut feeling says this might not be the right deal, Rory would always advocate, don't do it. And John's point is, stick to letter of law, be honest, open and transparent with the revenue, and you won't get a problem, which is why John is so successful. John, over to you.
In terms of, everything you're saying is correct. There's plenty of legitimate planning you can do, and you just tailor the law to your circumstances. You don't try and leave yourself into something that doesn't work.
Yeah, simple as that. Right, next one, and it's a very hot topic at the moment, which is second homes or holiday homes. So obviously a lot of people at the moment are moving into the holiday home market, but we're also seeing a shift in, I suppose, your wealthier clients buying properties or second properties in the Lake District. They're going to rent it out, but they're not going to rent it out. Now, John, can you just give us a bit of an insight in terms of what would make a true holiday let, and when tax relief could be applicable in terms of how much personal usage they're able to have, if any, on a so-called holiday let?
The specific regime you're alluding to is called furnished holiday lets. Okay, it's got that title in the legislation, right? And it is known by the revenue as furnished holiday lets, right? So part of it's in the name. It needs to be furnished. Okay, so you are letting out a property that is furnished and suitable for letting. Okay. Secondly, it has to be available for let for at least, and I always get the days wrong, I think Roger knows this better than me, I think it's 240 days in the year, right? And it needs to be actually let for 120 of those, okay? You can't lend it to any one, let it, not lend it, to any one person party for more than 31 days consecutively, okay? So it is most definitely for short-term holiday letting arrangements, right? You can use it personally, right? Provided you fall within that criteria. If it's in a company and you use it personally, you either pay the rent or you pay the benefit in kind on the foregone rent. Yeah, but it's a very strict regime, very strict regime. So these circumstances where people are like, I've let it out a little bit and somebody uses it twice a year, and that kind of, it doesn't fall within the furnished holiday let regime. So you're not getting the same rule. Now, the release on furnished holiday let are basically, you can claim capital allowances on the assets you have in your furnished holiday let. It is deemed to be a trade, so you get trading income. You can offset your trading costs, and the disposal attracts, it's called business asset disposal relief, was entrepreneurs relief, but basically a 10% rate of tax up to the first $1 million of lifetime gain.
Okay. Wow. Again, great, because a lot of people wouldn't know that. And I know there's a lot of people trying to bend the rules on this sort of style of property. So thank you very much for the clarity, because it's very much a hot topic at the moment with people purchasing holiday lets, with the staycation market being so hot. Yep. So thank you very much. And Kieran, hopefully that answers your question. We've just got one coming live from Michelle. So thank you very much, Michelle. Hi guys, I have a client that purchased a property and lived in it as their resi for a few years. They then moved out and let it out on a consent to let, but they lived in it rented whilst they did this. They then remortgaged it in their personal name to a buy to let. They have recently purchased a new resi that they live in, and they have set up a limited company as a new business as they wish to build a property portfolio. Now they are wanting to sell the buy-to-let from their individual name and buy it under the new company. So are you able to advise, will the company have to pay stamp duty on the purchase of this property? Never done one of these before, so if so, is it a different rate? The client has also mentioned that he believes he can obtain a stamp duty refund on his current resi purchase. Also, is this correct? And what are the parameters of this, please?
All right. So yes, the company will pay stamp duty land tax. It will pay it at residential rates plus 3% charge on top. And that's even if it's the first property in the company. He's purchased it, buy-to-let it, and they haven't moved into another main residence.
They have now. Sorry.
Yeah. So yeah. So if the purchase of the second property is within 3 years of the disposal of the first property to the company, yes, he'll be able to reclaim the 3% surcharge on his second purchase. If it's after 3 years, he won't.
Yeah. No, that's perfect. And hopefully, Michelle, that answers your question. And again, I think that's another hot topic because it's what Rog, you helped my sister with a few years ago. Scenario was she owned the first property. It was worth, I think, £125,000. Was going to move and buy a bigger property, but didn't want to sell this one because a lot of memories and wanted to start a property portfolio. So with her onward purchase, I think it was 450 grand at the time. So obviously she had the increased stamp duty because she was retaining this, the properties are let to buy. So then at that point, Roger went, well, why don't you sell your current residential property, sell it to your limited company? And my sister went, well, with that, obviously I'm going to have to pay stamp duty and associated fees and moving it to the limited company. But of which, obviously, if you're doing that and disposing of it, then obviously you don't pay the increased stamp duty on your onward purchase on your new residential. So I think, long story short, overall, she saved about 5 grand in stamp duty and fees, didn't she?
Yeah.
So, there's a lot of people which ultimately are looking to do that, but when they look at the actual overall cost, one, they either pay it and then don't recoup that money back, or they just dispose of the asset because they haven't got that money available and it doesn't make financial sense. So I think if you ever have clients that are looking to retain that asset, it may be worth looking to sell the existing property to the limited company. It doesn't work every single time. It's not cost effective every single time from a stamp point of view. But if you're looking to build a portfolio, obviously you get taxed on your profit rather than your income, then it's definitely worth, again, seeking tax advice, looking at the total costs of the current structure to sell it to a limited company. Because I think a lot of the time it can be cost effective. But again, you work out the calculations appropriately because it's not all the time, but it's a fair amount of the time. I think you'd probably agree with that.
Yeah, Dan, I think with Heather, a situation was the property she had, her first home, she wanted to retain, but the property buying for 450 should have paid 3% on that. So that worked out just over 12, 13, trying to work in my head, £13,000 extra money. Because the property was only worth 125, she only had to pay the 3% on that. So she was going to have to sell it anyway because she didn't want to pay that lump of extra second money on a new property. The solicitor had actually got it wrong. The solicitor originally was trying to give bad advice, and we often hear this, that's not what my solicitor said. That's why I insisted we wrote to HMRC, told them the scenario, told them what we thought it was, and they wrote back and confirmed that our interpretation was correct. With Heather, she was then going to sell her own home and go out and buy a new buy-to-let. So it was a question of, Heather, why don't you just buy your own house, move into a limited company? It was actually John who kind of quantified the advice in what we were doing. So it was kind of a seamless transaction in what occurred. And at the end of it, Heather has got a buy-to-let, which is a property she knows well, and it's since gone up quite a lot in value, and the new home was a Roney property at the end of the transaction. Now, a lot of the times you'll hear of people will be on these webinars and go, God, my client's just done that. They've just bought the new home. They've paid the extra 3%. What can you do? And as John said, as long as within 36 months of the completion of the purchase, the revenue by doing the submission return, within a month we'll rebate that money back if it was appropriate. They're very fair and supportive in those situations. And from a lender point of view, Dan, we're very happy with Let to Buy. You know, even if Precise had the mortgage on the resi, and then they wanted to convert that resi to a buy-to-let and then do the onward resi, we'd still do both. We're very happy with that, Dan.
And I think the clients will be as well, because again, you're just adding the value of your advice. So they'll think, bloody hell, do you know what, Rory's just advised me on this. He saved me a ton of money. I'm going to recommend him more to my friends. And you're going to get another deal out of it as well. So you're going to get the resi purchase, you're going to get the limited company buy-to-let, and you're going to get referrals off the back of it, because not only are you doing the transaction that came to you for, you've saved them a shed load of money, and you put it in a more cost-effective tax vehicle ultimately. So again, it's just adding another string to your bow, and it's kind of working smarter, not harder, really, isn't it? So I think a lot of people aren't aware of that at the moment. Bloody hell, as an advisor, you've got so much to remember, to know, and to do. So we can't all be as much of a wizard as John at times, but yeah, it's just something to bear in mind.
A quirky pub quiz fact.
Go on.
All right. So you were saying the revenue were quite fair on stamp taxes. They've had a lot of practice at it. Stamp duty is the oldest tax in the United Kingdom. And COVID was the first time in 400 years that the stamp office had closed its door.
Wow.
Interesting.
Wow. That's a fact.
That's madness, that. And an interesting one, I've spoken to, well, only two people recently, but a lot of people seem to be, well, not a lot, these two people seem to be under the impression that with the way the market's going to cool down, and we're not as much in a recession as it stands. Property prices aren't falling, and they might be slowing down as such. But what are your thoughts on stopping stamp duty? Stopping stamp duty, put another holiday in to keep the market going so the market doesn't crash. Obviously, we've done it a couple of years ago, but what are your thoughts about them doing it again to keep the market mobilized? Do you think that will happen? Do you think it was a one-off? Do you think they'll lose too much money?
Can I go first on this one, John? My prediction, I've seen a number of articles and follow the money markets very heavily. I think what you'll see is with the inflation going up again, you're going to see another possible 0.5% base rate rise. Now, we look at base rate rising. We need, Bank of England have always said, once we get back to a stable economy, we want a base rate around the 2 to 2.5%. You need that. So I've been through more recessions than both of you. I'm older than you, John, so I'm going to take that. You're only in your 30s. But we go in cycles. So you get a recession, you drop interest rates. You come out of a recession, you put interest rates up. It's a big lever to be able to support an economy through a negative time. My guesstimation will be next year, if we are in a recession, which would be the most unusual one I've ever seen, because we haven't got enough people to fill the jobs. We're expanding. We've got changes to come with a different type of regime in government. And next year, you will see more and more people coming off fixed rates, who therefore the next year is going to be a remortgage product transfer mortgage market. My gut feeling is the worst year to be coming out of a fixed rate, Dan, is next year. The sweet spot would have been on a 5-year fixed last year, because I see, and this is purely my own opinion on the market, I see interest rates going to 2.75, and then I see by 2024 to 2025, that dropping down to 1.75, with inflation then dropping back to about 0.85 around that 2025 period. So interest rates must rise. Young people, anybody who's not had a mortgage in the last 17 years, haven't had a mortgage in that period, need to understand interest rates need to rise. They were never supposed to be at 0.1%. That was because of the world banking crisis and also COVID. So we're starting to come back to some form of living normality. And the quicker we get interest rates up to what's classed as an acceptable level, which gives the government and the Bank of England some movement, will work well. So I actually indirectly do welcome rate rises when we can get to a normal of what we need to be for an economy that's vibrant and moves. So you need interest rates at a reasonable level and inflation to balance with that. At the moment, this is out of parity, and that's to do with the energy world crisis, Ukraine, and other issues. John, what's your view on that?
It's along similar lines. There won't be a stamp duty holiday.
No.
Basically, if you're looking at, I mean, the reason for inflation at the moment is World Bank's printed money, so there's a lot more money in the system, and there's been because of COVID, a contraction in supply. So there's more money chasing fewer goods. I understand centrally commodity prices are coming down, so inflation is going to work its way out. And in terms of a recession, the government, if it's going to, will look to support industry and investment, and stamp duty supports one industry. So they are, I mean, if Liz Truss gets in, it's looking like they're going to hold the corporation tax rate, and the national insurance rise will be removed, which has a direct impact on companies investing in the UK and on disposable incomes. Whereas a stamp duty holiday is, to an extent, the purchase or sale of a property is a discretionary spend and only supports one industry. So I can't see it.
Okay. No, interesting. Again, I personally couldn't, but it's something that a few people had said to me. And Rod, where do you think the market's going to go? Because it used to be very much a tracker market, didn't it, up until a few years ago? Do you think we'll see a tracker market return when these fixed rates do start ending?
Oh, I think my personal opinion was many years ago was trackers, because I always predicted in my own head around 2006 that we would follow the Japanese economy, would end up with very low inflation, growth in economy and base rate. This moment in time, you've got to think about, would I be going next year? I wouldn't go into a 5-year fixed, because I think the cost of a 5-year fixed next year will be far more expensive than 3 years from now. So I could see people next year looking at 1 or 2 year fixes to ride the hump, or maybe even ride SVR before locking into a longer term fixed rate. The first time for economists, we've got to it's been ages since we've had to look at the effects of the Ukraine and the global energy prices, which is a huge factor in our lives. We've never seen that before. Back in when we had all the disputes with unions, and if we do have all these pay increases where everyone gets 10%, inflation will move up 10%, and that suddenly 10% goes back to zero. So it's how do we allow people to live, the cost of living and sustainability. You know, so many factors are going up. So I think from a landlord point of view, long-term fixes can be very attractive. You know, 10-year fixes on buy-to-let, because you're going to own the property without moving. But for residential, I really need to think it through. It depends on how young you are. If you're a young couple with your first ever house, then fixed interest rate movements can be quite frightening. But for an older person who's got a reasonable amount of equity, it's a different conversation. But we are going to see interest rates carry on rising until we get to a bit around the 2.25%. I think we're going to have another 0.5% in September, and then we might start to see it settle down. It depends if inflation gets away, and then that becomes into a really tough cycle. At the moment, it's very hard for anyone to really predict where this is going to go out, and the attitudes of whoever takes over the Conservative government for the next couple of years, Dan.
Thank you very much. Well, I'll come back to you in 2 months for your views and update on that. So again, it's very useful because I know a lot of people appreciate your view on this sort of thing. Does anybody have any more questions to come in live? Obviously, we've got 15 minutes left, so we're coming up to the end of the session. But we've got a couple more that came in previously. So David, this one came in from yourself. So John, if a client moves back to a property that was previously a buy-to-let, is there a minimum period they need to live in it to be able to claim personal residential relief, and if they can claim the relief on all of the gain from original purchase, or is it just from reoccupation?
Right. So there's a couple of misunderstandings around main residence relief or principal private residence relief, whatever you want to call it. Okay. So if you live in a property as your main home, when you sell it, it's free of capital gains tax, right? People think, and I come across this situation quite frequently, I've got a buy-to-let and I'll live in it for the last 6 months of ownership, and then it'll all be free from capital gains tax under main residence relief. It's not. The relief would be on the period it was your main residence. So if you owned it for 10 years and you lived in it for the last 6 months, under a quirk of the legislation, you would get the last 9 months as main residence relief. Well, basically what you do, if you had a gain of 100 grand on that property, 9.25% or 92.5% of it is taxable. And the small amount where it was your main residence is non-taxable. You can live in a property as a main residence, move out for certain reasons, so you're required for employment, or you can move out for 3 years and move back in again, and you'll qualify for main residence relief. But generally speaking, it's only the period of occupation and the last 9 months of ownership, and those two figures can obviously overlap, that would qualify for main residence relief.
Okay, perfect. Thank you very much. Roger, you looking confused?
No. It's one that the government have recently changed the rules. They used to be 80 months, dropped down to 9 months. And it's one that we do see some dishonest practices where people have listened on some forum and it's a question, it's been a buy-to-let for years and they jump back in. The revenue won't know. The revenue created the most sophisticated tax system the world has ever seen. It is so impressive. It's the envy of every other nation. I'm trying to remember the name of it, John. I've got it written in the book. They have a name for it. It was a book. What?
They do. I'll see if I can find it.
Oh, there was a name for it. It's in this book, which is called Daylight Robbery. It's a tax book I read on holiday. And what the revenue are able to do is they've got millions of algorithms. So as you as an individual, Dan, they connect to your Facebook, your Twitter, your LinkedIn. They connect to the local. Local. It's what?
Well, connect.
And it is absolutely phenomenal. So they know they've got a data feed into the local council to who pays the rates on that property, who pays the water bill, who pays the electric bill. So if you said you've lived in a property forever, within a nanosecond, they know if you have or you haven't, because of everyone's got so many digital footprints in so many different ways. So if you try and say, maybe you lived in it for the first 6 months, rented out for 10 years and moved back in for 6 months, you might be able to try and just blag to the revenue you've always lived there. It's purely, every property now has got a digital footprint, which is why those landlords that don't declare the rent, when eventually it's sold, the revenue does a digital analysis. And if at any point you haven't been responsible for every electric bill, every gas bill, your rates, if there's any electronic data feed to that property appertaining to anybody else, they'll be able to then investigate, and you'll have to pay the appropriate taxes and fines. Mm-hmm. So the world is a far different place with the revenue, which is why they're able to, unfortunately, have so many staff, because it's no longer down to human error. It's digital footprint now. And that system, every other country is trying to develop that system. The NHS's system, where the messed up we all heard about, but the government don't seem to brag about the sophisticated success of the tax system, John, but that's just life.
Do you know where the phrase daylight robbery came from?
Yes. So the daylight robbery came from is when they implemented the window tax, which succeeded the hearth tax. So when the feudal system after we had the Battle of Hastings, we introduced the hearth tax, which you could argue was the reason that the Great Fire of London started, because you could knock a hole into next door's wall because you didn't want to pay for a half tax and nick their heat. So what they realised is it's hard to necessarily tell how many halves that you've got in a property, but windows, well, you can see them. So they had a window tax, which then moved to a glass tax. But it was the debate in Parliament in 1850, where apparently the MPs chanted, "This is daylight robbery," because what was happening is as landlords who had tenemented HMOs, they would board up the windows in those properties that were rented out on a room basis, thus robbing people of actual daylight to be able to mitigate a tax position.
Jesus. Okay. There we go. History
Right,
lesson. It's like story time with Roger and John. Bloody hell. I didn't actually know that. That's quite a useful bit. I mean, I'd probably never use that bit of information.
Pub quiz. It's always in a pub quiz.
Yeah, I'm guessing you got a few of them with the stuff that you seem to harvest.
Me and John are the Northwest champions in the last 2 years running, funny enough. But anyway, Dan, that's for another time. We'll have to get Rory to come along on one of ours because he's quite good.
We do digress, don't we? There we go. Very diverse in here. Terry just said, shame the tax system can't do the same for Google or Costa.
Does Terry want an answer? Does Terry want an answer?
I'm sure you're going to give him one, so crack on.
All right. So there's a lot of people going on about these big corporations and the fact it's kind of like they can't track down the tax charges. Two things on that. There's a specific tax been brought in called diverted profit tax. So where Google tries to set up its advertising in the UK and divert it out to Ireland, there's now a 25% tax on that, and they are captured by that. The second thing is that there is a tax charge for use of brands. So you can pay for the use of a brand, which is what a lot of these entities do, and that's why traffic or funds go out to the UK. It's been legitimate planning for years, and I don't have a lot of sympathy with these organisations, but you've got people like Google who are paying enormous amounts for property in the UK, and Costa and property in the UK, and they employ enormous amounts of people, and they pay a small fortune in PAYE and VAT and stamp duty, and they're generally not avoiding taxes. They plan to avoid a small amount of corporation tax. They do provide a vast amount of tax to the UK purse.
Amazon's a good point to that, John. Its infrastructural investment and employment is breathtaking. And as much as we don't necessarily see the headline of what they're doing on the profits, but you know, their reinvestment within the infrastructure and complexity within the UK is incredible. But I think the G7 got together because they kind of looked about where do we stop this and how do we change it? And it's part of, but if you actually look at when you actually look at the history of taxation and you look at the
here we go.
The difference between the size of the UK tax manual is possibly about the largest in the world. But you compare that to Hong Kong, which is the most prolific from an economical point of view, has possibly the smallest tax manual and principles. Yeah. And it's trying to weigh between the two, between the diversity and fluidity of the Hong Kong tax regime against the UK's.
Perfect. Thank you very much for that. And again, you learn something new every day. Do we have any further questions to come in before I start wrapping this up? We've got about 5 minutes left. And again, it's been a very informative session. We've discussed lots of different topics. And to be honest, quite a bit that's off-piste, which again is always good and why we enjoy doing these sessions. And I just want to quickly kind of plug our business for a second, if I can, because we don't normally do it on these sessions. It's not about plugging businesses. It's more about education and just showing off John and kind of his wealth of knowledge. But I think as the market gets more complex and lenders are pulling more products and clients, unfortunately, are getting more and more specialists, then I think if you're not, or don't have a partner like Crystal, a master broker, packager, introducer, whether it's us or one of the other guys in the marketplace, and I think you could be missing a trick and creating more work for yourself, really, because we're seeing more and more people use us where they're dipping the toes into different sectors which they may have not previously dealt with, whether it's bridging, commercial and development, because ultimately their mainstream vanilla residential and buy-to-let stuff is drying up. we've seen it, the market's drying up. More and more clients have got adverse, the incomes are more complex, the properties are more non-standard, or they're just diversified. And unfortunately, the high street's appetite isn't changing. If anything, it's going to get a lot tighter. So I think if you are dealing in these sectors, you want to dip your toe in these sectors, or just looking for a helping hand, or you're trying to source a unicorn for a product that doesn't exist, I think you do need to start linking up with people like ourselves. We've got a team and a workforce in place which is huge and experts in every single sector. And I do think that a packager, now more than ever, can add a lot of value to your business. They can save you a lot of time. But more than anything, we can earn you a shed load of money, because we're helping you complete deals which you've never completed before, you've never even thought about before. But now, because you're wanting to diversify your income and not have all your eggs in one basket, then we can help you along the way. We can help you learn and help you earn. And it's as simple as that, really. So I think anybody wanting to get in touch after this session, please do pick up the phone to us, because we're always there for a chat. We've got a great friendly team. We've got a dedicated mortgage desk which can help you with your questions there and then, so we can give you a quick yes or a quick no, and it's not a long maybe. And that's it. But I just want to show you the importance of a packager, a master broker, and someone you can really build a strong relationship with. And I think if that's the end of the questions, then we'll kind of wrap it up there, guys. So do you want to leave any last words before we end the session? Again, it's been informative. It's been very diverse. I've certainly learned a lot, as always. And thank you very much for your support, as ever. So, Rog, if I can pass over to you, please.
Yeah, Dan, I'd just like to reiterate and underpin what Dan's just said. I started a packager in 1995 after the recession as a mortgage broker, realised that where you could give the best value and help is through a packager. And that packaging service carried on until it was eventually taken out in the recession in 2008. But what I would say to you is there's definitely headwinds to come. More and more clients are going to need your help than ever before. Focus 100% of your time on engaging with the client and working out what their problem is, and partner equally with Crystal and let them take away the complexities of the lender criterias, and you provide that forward front service. So if you as a broker think of yourself as a maitre d' and stand at the restaurant door, and Dan's in the kitchen preparing whatever meal that customer requires, whether it be beans on toast or escargot, but the partnership with Crystal will give you the edge over the competition of brokers in your area, will be my closing statement on that, Dan. John?
Yeah, no, it's more sort of macroeconomic. It's just one final interesting fact, really, looking at the whole environment. The government's tax take, due to the inflationary environment we've got at the moment, has increased approximately 23%.
Wow.
Yeah, so they raised in the last 12 months 730 billion in taxes without doing very much at all. They froze allowances, and because of the inflation, so we are inflating our way out of debt at the moment, and we are very highly taxed. And as Roger said, it's a complex system, a very complicated system. And so it's generally to your benefit to take some tax advice around these things. There are savings to be made if you do it properly.
John, I would say that's the most profound statement I've heard you say in all the time I've ever known you.
Absolutely. And again, wow. John is an expert. He's a great asset. If not, he is the center and central kind of cog in this wheel, really. And as much as he's a great guy, we don't pay him to come on. He doesn't pay us. We don't give him any kickbacks as such, and vice versa. So anything you pass to John, we don't get involved in. There's no relationship there. It's just the fact that John is one of the best in the industry. He's one of the most knowledgeable people you could come across, and he'll help you with your clients. And that's it. That's the reason why, as I always mention, John is on these sessions. Nothing more, nothing less. He's a great guy. We've got a great behind him. And again, anyone that does need tax advice from someone who is genuinely knowledgeable and that you can trust, then please do speak to John and reach out to him. And he'd be more than happy to help with any clients and build any relationships. But yeah, just to reiterate, we're a Swiss Army knife. We're there to help you where we can. We are the 5th emergency service. and we want to help you during these uncertain times, certainly help you complete more specialist deals, more complex cases, and earn you a decent bit of money and build a really good relationship off the back of it. But thank you all very much for joining today. We'll be back again in October. The date for that will be coming out shortly, and I'm sure there'll be lots to discuss then. So thank you very much for the last hour. Gents, again, thank you. I know you're both really, really busy at the moment. I hope everybody has a fantastic day, a great weekend, and I'll no doubt speak to you all soon. Thank you very much.
Yeah.
Bye-bye.